Today, I want to talk about how Charles Payne just confirmed we're in short squeeze season. I literally made a video on this last week, but was called a shill. But it seems like even the big guys know exactly where we are. I also want to talk about the new way in which banks are desperately trying to unload their risk. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, as Charles Payne tweeted, he said it's the most wonderful time of the year. It's short squeeze season. We've seen many of these small cap heavily shorted stocks like Carvana, Upstart, Affirm, Coinbase and others running massively over the last week. We saw the S&P 500 also go on an absolute tear, and both of those combined puts short hedge funds in a very stressed position. When these shorts are stressed, they first close out of their large blue chip shorts. Then they close out of shorts on heavily shorted names until finally saving the biggest for last, their AMC, GameStop and meme stock shorts. And it seems the banks are desperately worried about how much risk they're holding, and they're trying to sell off that risk to hedge funds and private equity firms. As Finance Lancelot tweeted, he said, breaking news. Banks are selling risk to hedge funds and private equity firms through so-called synthetic risk transfers. So the Wall Street Journal article says that big banks have cooked up a new way to unload risk. It says JP Chase, Morgan Stanley, US Bank and others are selling complex debt instruments to private fund managers as a way to reduce regulatory capital charges on the loans they make. These so-called synthetic risk transfers are expensive for banks, but less costly than taking the full capital charges on the underlying assets. And also saying they are lucrative for the investor, who can typically get returns of around 15% or more. Now this is really fascinating. These banks like JP Morgan, Morgan Stanley and US Bank are paying money to reduce their margin exposure. These banks obviously can't take on the full capital charges because they're too close to their margin limits. And therefore they're paying money to have somebody else take over some of that margin so they don't breach their margin limits, and they're paying 15% of the entire loan, or 15% returns. That's crazy that these banks just aren't taking the full capital charge, as it'd be free to them and they wouldn't have to pay 15% returns. But obviously these banks are too close to their margin limits, which suggests to me that any change in the market that is somewhat dramatic could cause many of these banks, like even JP Morgan and Morgan Stanley, to breach their margin requirements. Jamie Dimon, the chief exec of JP Morgan, said regulators have been rising capital requirements for years, and they proposed even tougher measures after the banking panic that began in March. He also added, saying higher interest rates are eroding the value of banks' investment portfolios, which can also eat into regulatory capital levels. So basically these banks are already close to their margin limits, and because their investment portfolios are decreasing, they're getting closer and closer to breaching those margin requirements. So close, in fact, they're having to pay other people to take on some of that margin risk. And not just pay them 1 or 2 or 3%, paying them upwards of 15%. Also with Mumu, you can currently get up to 15 free shares worth up to $2,000 each, and any uninvested cash gains interest at 5.1%. To sign up for Mumu, just use the link down in the description below. Mumu is very easy to sign up, it's free to use, it just requires that temporary deposit to get those free shares, and they've got tons of technical indicators, advanced charting tools and their own options trading platform, saying the deals function somewhat like an insurance policy, but with the banks paying interest instead of premiums. Now that's really interesting because it's pretty much exactly what Michael Burry was doing back in 2008. He was shorting the housing market and paying interest on those credit default swaps. So these banks have basically taken out credit default swaps on their own loans that they're giving out. And obviously they're paying the interest so that if those loans go bad, they don't have to suffer the losses. Somebody else will. That to me sounds absolutely nuts that major banks like JP Chase are buying credit default swaps on their own loans that they're giving out to customers. But perhaps the best part of all of this is that hedge funds that are buying these complex derivatives, if those loans do go bad, it's those hedge funds that are going to take on billions of dollars in losses. And if these loans do go bad, hedge funds are going to lose billions, more banks are likely going to collapse, and the entire system will be a giant mess. We've already got Ares Management, Magnetar Capital, and DE Shaw buying these risky complex derivatives. I wonder if Citadel will buy up tons of these dodgy loans, and hopefully those loans go bad, causing Citadel billions of dollars in losses. And speaking of Citadel, check out this really cool due diligence. It says investors in Citadel's hedge fund are literally propping up Citadel's clearinghouse. It says after disclosures from Citadel Advisors LLC, it looks like Citadel Advisors fully disclosed how investors in their hedge fund basically support Citadel clearing, including during periods of market turmoil, aka the mother of all short squeeze, even at risk to their own investments. So if Citadel Clearing experiences a period of market turmoil, Citadel Advisors LLC and their customers will bear the losses. So for investors in Citadel's hedge fund, those investments are funneled to Citadel Clearing or Citadel the market maker in exchange for ownership in Citadel Clearing itself. This entwines the success and failure of Citadel the market maker with Citadel the hedge fund together, such that the failure of one effectively guarantees the failure of the other. So if those risky loans these hedge funds are taking on from these banks do end up going bad, it could not only bring down Citadel the hedge fund, but also bring down Citadel the market maker. And it also says to the extent that Citadel Clearing, aka the market maker, requires additional capital, aka rescuing, the advisors or the hedge funds may require the Citadel Clearing funds, aka some of those individual hedge funds, to contribute additional capital or increase the size of their loan to Citadel Clearing. aka Citadel Clearing will demand that Citadel the hedge fund bails out or rescues Citadel Clearing to the best of its extent, aka likely bankrupting all of the investors in Citadel's hedge fund, taking all of their money and likely losing that too. And as Just Dario tweeted, it seems the DTCC is already preparing for just how much risk is in the market by increasing margin requirements even more. He tweeted saying the DTCC has just doubled the margin requirements for mortgage-backed securities. So that's why these banks are desperately trying to shift their risk, because they likely won't meet these new margin requirements. And that's why they're desperately trying to get other hedge funds and other private equity firms to assume that risk and those margin requirements so they don't have to. I'm personally very interested to see what happens over the next few weeks, as, by the way, banks only have 2 weeks to prepare for these changes. And also interested to see what happens over the next few months. Will more banks end up collapsing? Will banks fail their margin requirements? And will these hedge funds take on too much risky loans or too many risky loans and end up defaulting and going bankrupt themselves? Because don't forget, these hedge funds don't have the same stringent margin requirements that banks have. So if they take on too much risk and that risk blows up in their face, it's game over for those hedge funds. And finally, I wanted to quickly cover how these shorts are desperately running out of liquidity and how the squeeze is just around the corner. This post says at a certain point, one of these hedgies doesn't have enough liquidity to increase their margins or to avoid margin calls anymore, resulting in them getting forced to cover at market price or shifting even more risk onto another hedge fund. Ultimately, that will eventually result in a price spike, resulting in more hedge funds not being able to meet margin requirements, resulting in them being forced to close short positions, resulting in further price spikes, and the spiral will continue. And to see how much liquidity these hedge funds, these shorts and these banks are losing, check out this tweet from Bigham's focusing on the reverse repo facility. He tweeted saying down and down it goes. Banks don't have as much to park overnight, neither do hedge funds, and notice the participants are slowly dropping also. At one point, this reverse repo facility built its way all the way up to $2 trillion and is now about to drop under just $1 trillion. These banks are losing liquidity day by day by day, and the system is slowly being drained. And obviously, when these funds run out of liquidity, the squeeze will happen. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.